Prashant Khemka joins us now. Let's take a conversation forward. Let's take a conversation forward and understand what he feels that where markets are headed and how will 2022 will be different from 2021. Prashant, good morning. Thank you for joining us. Uh, Prashant,
Thanks
how
for
do you
having me.
think the market positioning for 2022 will be different from 2021? Because 2021 was like a market which was dominated by absolute rise, great gains, fascination, imagination, NFT, crypto. What do you think will be the underlying theme for this year?
See, we are constructive on the market. It's obviously impossible to say, just as it was a year ago, how the market would do and which particular sectors or themes might play out in the near term stronger than others. But on the whole, I would say we are constructive on the market in that we believe we should earn though a more normal return, which generally is a double-digit 10 odd percent return in line with the nominal GDP growth of the country. Corporate earnings should grow faster, uh, just given where the year-over-year comparables are going to be. We believe corporate earnings should in FY23 grow, or you can say calendar year 22 should grow in the mid to high teens. Um, certain sectors would have stronger earnings, but does not mean those would necessarily do better in the market because the market is anticipating stronger earnings from some of those. If you ask me how our team is seeing where our team is seeing greater number of opportunities, it's quite consistent with the prior year or years where we do find a greater number of opportunities in the tech space, IT services in particular, as well as private financials, so private sector financials. These two, um, along with opportunities in consumer and healthcare as well. Back to you, Nikunj.
Okay, so let's pick up all the sectors one by one. And what really rings the bell is when you say consumers. Now, based on P multiples, consumer stocks are expensive. And when we know that interest rates are likely to go higher, which could compress P multiples, what makes you bullish on consumer stocks?
So, so first of all, we do not ever approach in a top-down manner, whereas we don't take a call on a sector because we have never taken and unlikely ever would a call on sectors based on macro variables like where are interest rates headed and so on. Remember, interest rates have been expected to head higher, first of all, for the last 13 years, right? Second, so first of all, we never make these investment decisions from a top-down perspective. Second, I would say when I say consumer, I include more broadly everything that is, consumer staples as well as consumer discretionary. I believe you particularly when you're talking about higher P multiples, you're talking about uh, staples, but obviously, yes, there are many stocks in consumer discretionary as well, which may be on a higher absolute P multiple. So that's second point. Third, when you look at P multiples, which we don't, by the way, but I'll come to that in just a minute. But P multiples or any multiples or valuations have to be viewed in context of relative to where the rest of the market is. So the market itself at this time, and I'm not saying that means it is overvalued or stretched valuation or anything. We very much believe, as we always do, the market's reasonably or fairly valued. But at this time, yes, on P multiples, market is towards the higher end of the range. And fourth, most crucially, we never value a company based on its P multiple. We have a very deep-rooted disregard for P multiples as a metric for valuation. We're more cash flow based centric, and on those in that approach, we do still find, and again, no single sector do we view as more attractively valued from a valuation perspective on the whole or anything. But within every sector, or most sectors, let me put it this way, particularly the sectors that I mentioned, the team does find quite a few number of attractive businesses that are trading at attractive valuations as well, including the consumer staples and discretionary sector.
So how is your portfolio at the beginning of 2022 different from what it was at the beginning of 2021?
It's in many respects more similar than different when viewed from a top-down sectoral composition and market cap composition. And uh, and the fact is, more or less, it remains similar year after year. So there are certain sectors where we hardly have any exposure, and I hardly had any exposure historically, say in utilities or energy. And there are certain sectors where we tend to find a lot of attractive opportunities, not from a top-down sectoral preference perspective, but we tend to find over the last many years attractive opportunities in financial services and technology. Again, private sector financials and technology. So that's not any different. So the individual companies underlying the portfolio, underlying these sectors could vary. But again, there's not a huge lot of difference in the character of the portfolio. It remains a portfolio of what we call great businesses at attractive valuations. And great businesses being the businesses that possess the kind of attributes that we really like, such as superior returns on incremental capital, scalable and well managed, both in terms of execution and governance. I can elaborate further, but the character of the portfolio is not much different from what it was a year ago or 2 years ago.
Good morning. You've always talked about markets will not be impressed unless you see a double-digit growth in revenues and all. You've also said, taken pride in having a broad portfolio. However, you do seem to have always had a bias towards the financials and the IT stocks. They could be new age and the decade-old ones that are already delivering profit. Would you be adding industrials, manufacturing stocks, textile stocks? Because those are the ones that are also making a comeback. For the first time in 10 years, the revival of the capex cycle is real.
Certainly. So you're correct. We've tended to have higher allocation in these two sectors, as I mentioned, but there are numerous wealth creators or alpha opportunities in these. If you look at these sectors, there are a large number of companies that are very entrepreneurially run. Again, I'm talking about private sector financials as well as IT services and the other sectors that I mentioned. So these are because of the very large number of companies with good governance. Again, at the risk of generalization, you'll agree that there is a larger number of well-governed, from a corporate governance perspective, there's a larger number of well-governed companies as a proportion in technology in India than, let's say, in real estate or industrials. Again, at the risk of generalization, there are some very finely governed companies in real estate and industrials as well, and we do own them. We do have investments in real estate and infrastructure and industrials. It's just not as high an allocation in the portfolio because we have fewer number of companies that we can find in these sectors. But to your question, we do own companies in industrials as well. And then those are very fine. We like those companies just as much as the other companies in the other sectors that I mentioned.
Prashant Khemka, once you were here, you did talk about how India offers the highest potential for alpha generation on this planet. So are you going to do that primarily, once again, with financials or new age tech companies? The reason I ask you this is because you've also said that you've not felt the need to change your portfolio now for almost 2 years.
So again, the portfolio has changed. The underlying companies have changed, but the overall character has not changed because we've not made any, top-down reallocation from one sector away to the another. So the underlying companies within broadly technology, if you say. So obviously you mentioned about new age tech. New age tech was hardly, there were far fewer companies 2 years ago. So there are new companies that have listed and some of them have found favor with their team members and are in the portfolio. But within the traditional IT services sector also, there are several companies which are there since more than 2 years ago. But then there are newer ideas that have made their way into the portfolio. So it's not that the portfolio is the same as what it was 2 years ago. What I'm trying to say is that the character of the portfolio has not changed, and it so happens that over the last 2-3 years, the sectoral representation has not materially changed, even though the underlying names beneath the sectors in both private sector financials and technology might have changed. As it comes to the new age tech, the team evaluates every single opportunity. We do believe that some of the companies that are getting listed would go on to become very large wealth creators, but that's not a generic or generalized statement on all the companies that are getting listed. We just look by observation in what happened in the US, what happened in China and elsewhere in Asia. The new age, so-called new age tech companies have come to represent 20 to 30% of the market. Right now in India, they are probably a tenth of that, maybe 2 to 3% or less, actually. And we do believe over the next decade or so, this segment of the market would grow to become 20 to 30% of the market. I'm not suggesting it's the very same companies that are listed right now that will grow to become such large component. There'll be a lot many more new companies that would get listed, and this segment would become more and more prominent. And it behooves, as I've said before, any investment team to pay close attention and look for ideas and investment opportunities as we have been doing.
You know, Prashant, that's exactly what gives me conviction about India equity markets. The amount of long-term India capital which is sitting on the sidelines waiting for these cream unicorns which are created almost dime a dozen on a daily basis, so to speak. The fact that perhaps in the next 3 years we could see 200 new listings and the kind of implication that it's going to have for the market at large, not just the new age tech companies or the newly listed ones, but its bearing that it would have on the indexes as well alone. I mean, who knows? We could be staring at a market cap of $500 billion. Just wanted to understand, as an investor, do you need to really look at valuations then at this juncture? Because we're talking about a large growth multiple because of these new listings for the index as well, per se, and the overall equity markets.
A valid point. I think over time, that would become more of a factor that people would have to incorporate in their thinking when they think of multiples at the overall index level. Right now, the weightage of these so-called new age tech companies is still low single digit, as we just talked about. But yes, as that grows to double digits and higher, then the multiple of the index at the index level, the multiple would get affected, and then it would be more of an apples to oranges comparison to compare the multiple with a composition of double-digit percent, let's say, of the or 20% weightage of the new age tech companies. If you were to compare that multiple of such an index to an index from 10-20 years ago, then it would be somewhat of an apples to oranges comparison. We aren't there yet, because, as you mentioned, these are listings that might happen over the next 2-3 years and then incorporated in the index over such time.
So I'm curious to know then, Prashant, considering in 2021 we had a Nykaa on one hand and then a Paytm on the other, and many apples to oranges kind of listings, what really have been the lessons for a public investor from the private market?
I would say the lessons from these listings is to evaluate every opportunity on its own merit and not have a blanket viewpoint on the entire new age sector. If you had a blanket viewpoint that all these companies are attractive and are going to be the future of the country and valuations hence don't matter because they're growing at 50 to 100% and whatnot, then you'll end up investing in all of these. And you just mentioned few, but there are many others, right? You'll end up investing in every one of them, and that might have turned out to be okay, good or little worse off or whatnot. But if you can be more selective. On the same token, let me finish that point first. So on the same token, you can't be dismissive of the whole sector and this phenomenon. You can't be of the viewpoint, oh, all these companies don't have, profits. Some of them don't have EBITDA. Some of them are too early in their life cycle, and some of them are, or not some of them, but all of them are extremely richly valued because it's a 3-year-old company coming at a market valuation of 100,000 crores, whereas you have these old traditional companies which have been there for 20, 30, 40 years, making so much profits, trading at 10 times P multiple, and so on. These are all arguments. And I had the opportunity to be working and managing US portfolios during late 90s from 98 to 2006. All these are the very same arguments that were made of the Amazons and the Netflixes of the day when they were getting listed. Today they've grown to become trillion, $2 trillion companies, but that in those days, there were big question marks on these companies and many others, which obviously haven't done as well as Amazon and Netflix. But important point is you can't be dismissive of the whole sector, nor can you just go gung-ho and invest in every one of these. Important point is to be selective and do the work on every company and evaluate each such company on its own merit rather than painting them all with the same brush. Obviously, you won't be 100% right. You'll end up making mistakes. You'll end up with a few duds in your portfolio, no matter how well you do. But on balance, if you do the work properly, correctly, you'll possibly, end up doing better than the average.
So we're spending some time on this because it's historically said that IPO markets are not very price efficient. Merchant bankers, in a sense, try to price them to perfection or price the IPOs slightly ahead of the curve in a bull market. There were 60 IPOs, Prashant, which made a debut, which have made a debut in last 12 months. How many of those IPOs are on your radar? I mean, do you have 5-6 companies which you are monitoring, 2-3 companies where you've invested in?
Certainly. A good question. So you're very right that IPOs are an inefficient, more inefficient market than the public market. The public market, particularly the Indian public market, as was mentioned earlier, I believe is one of the most inefficient markets and hence provides one of the highest alpha opportunities. IPO market being more inefficient provides even a greater alpha opportunity. To your question of how many do we track at the time of the IPO, we think it's part of our fiduciary duty towards our investors to evaluate every opportunity that comes through. So we probably evaluated every opportunity. I said probably because some of them might have been so small that we might not have looked at, but any material sized IPO we would have looked at. We might have passed on at first look, maybe in 5 minutes, 10 minutes for one reason or the other, specific to our investment philosophy or approach, but it behooves us to again look at every such opportunity and make a decision, an active decision on whether to do more work or not to do further work. And many of these we would have done further work and then finally invested. Very happy with the work that the team has done during the last 12 to 24 months as it pertains to this segment of the market. Obviously, there is much larger already listed market and there's a very small IPO set of opportunities, but I'm very of the results that I've seen for the team, and we have tabulated these results to see how we have fared, particularly in this segment of the market. I'm very satisfied and happy with the outcome. And it's not just over the last 2 years, but even longer time period. We are now nearly 5 years old as a team. And over time, the team has done a very good job at this more inefficient segment of the market. And I believe any team that does its work right, research right, puts in the required work, primary level of work, because a lot of these things in an IPO evaluate company that is coming in IPO, the evaluation requires more work than a company that is publicly listed. But if you put in the right quality of work and amount of work and have a robust decision-making process, and if you're able to generate alpha and performance in the publicly listed market, then it's reasonable to expect you'll generate as much or more in proportion to the investment you make in the IPO market. And our results have been consistent with that.
Well, Prashant, really appreciate your time. So glad you could join us. Have a wonderful year ahead. I'm just going to
My
mark
pleasure.
markets right now. We are not